AI infrastructure is expanding rapidly, pulling billions of dollars into a complex web of hardware and software nodes. The companies building this ecosystem are generating real revenue, but they also carry high price tags. On the trading floor, these valuations often translate into extreme price swings. If you have $10,000 in cash ready to deploy, you have to decide how much of that volatility you are willing to own. You can split that capital manually across a hand-picked list of tech giants, or buy a single ticker that packages the entire sector into one asset. This decision defines your daily commitment for the next decade, setting the workload for portfolio maintenance and the level of risk you are prepared to carry. The active route involves manually building a concentrated portfolio of the industry's heaviest hitters. This top-heavy strategy puts 25% into Nvidia, 20% into Microsoft, and 15% each into Alphabet and Amazon. The remaining allocation goes to chip manufacturers, 10% to Broadcom, 10% to TSMC, and 5%. Instead of managing shares one by one, you purchase a single fund, like the Global X or Roundhill Generative AI ETFs. That single purchase automatically divides your $10,000 into fractional slices, instantly spreading your money across dozens of hardware, software, and robotics companies. Your workload drops to zero. You don't need to monitor individual earnings reports, because if one company struggles, its failure is offset by the rest of the fund. The trade-off is dilution. Because your money is spread so wide, a massive year from one top performer will only move your total portfolio value by a small percentage. You are trading the possibility of outsized gains for structural safety and psychological peace of mind. Asset selection is only half the battle. Your execution strategy determines whether your capital survives the volatility of this sector. Dumping all $10,000 into the market on a single day is a high-risk move, exposing your entire position to a sudden market peak. This jagged line shows the volatility of the sector. Buying in one lump sum risks getting trapped here at the peak. A safer strategy is dollar cost averaging, investing your capital in smaller, consistent increments over time. By investing a set amount monthly, you buy fewer shares when prices are high and more when they dip. Over time, your total purchase price averages out. This creates cash drag, where part of your money sits uninvested waiting for the next interval, potentially missing early growth if the market climbs. But this slow, methodical entry perfectly matches the mandatory reality of this specific sector, a long-term 5 to 10-year investment horizon. It takes years for data center builds and software integration to generate actual revenue. A decade-long timeline is necessary to see these hardware supercycles through to completion. AI is a long-term infrastructure play. Your portfolio structure will ultimately dictate your success more than any individual ticker symbol. This decision matrix routes your $10,000 toward the strategy that fits your profile. If you want maximum exposure to core leaders and can stomach single-stock swings, you are an active optimizer. The 7-stock manual split is your path. If you want baseline exposure without the burden of monitoring semiconductor earnings every quarter, you are a hands-off pragmatist. The ETF route provides sector growth without the daily maintenance. Both paths lead to the same final requirement. Can you leave this money untouched for at least 5 years? If the answer is no, this sector is too volatile for your capital. Whichever path you choose, using dollar cost averaging and committing to a 10-year hold is the only way to survive the volatility of the AI sector.